A very good afternoon to ladies and gentlemen. Welcome to another FSM1 event where we help investors invest globally and profitably. Thank you so much for attending the webinar today. Our topic of the day is Unlocking Opportunity, Capitalize on Asia Pacific Dynamic Equity Market. And we have Mr. Harry Leong, Head of Retail Business from Principal Asset Management Berhad. Before the webinar begins, allow me to give a brief introduction to Mr. Harry. Mr. Harry has been involved in the financial services industry for over 37 years, having considerable experience in the asset management industry, covering investment planning, wealth planning, investment distribution, and private retirement services. Prior to joining Principal Asset Management, he was a senior regional manager with the Global Fund Management Company. He has been with Principal since 2010, presently overseeing the retail business and product development function. He is currently servicing fund with the total AUM of over MYR 12.5 billion. Without further ado, let me pass to the Mr. Harry.
Thanks very much. Thanks very much for that, Elise. I hope my sound, my voice is okay and my video is okay. Good evening, everyone. Thanks for taking time out to join this event today. And thanks to Fund Supermart for allowing me this opportunity to share and to facilitate to share my investment team's latest thoughts on what's happening to the markets. Lots of things happening in the markets, a couple of last few days, last few weeks. And I think it's a good time and it's timely for us to share with you what we think and what all this mean for you in terms of your investment portfolios. So if we can go to the first slide where we have a review of the performances of all the major or key markets in Asia, including some indices for MSCI World, the US broad market S&P 500, as well as the stocks 600 Europe. So this is for the month of September. And of course, there are corresponding columns where you can see on a 1 month basis, 3 month basis, and all the way on the calendar year basis, 23 to 2020. So the chart shows colors. Green means is good, red means bad. So for each of the rows, you will see the corresponding performances of each period that we show here. So in this chart, you see the MSCI all countries Asia Pac ex-Japan index surged actually about 7.5% in September alone. This is in US dollar terms. And the best performing markets actually in September in respective local currencies were China. You can see Hong Kong as well. But Korea and Indonesia actually definitely lagged in the month of September, while the S&P 500 increased by about 2%. And MSCI Japan had a bit of correction. MSCI Japan actually declined by about 1.53%. So this is essentially a snapshot of what happened in September with the major key indices of the major markets in Asia Pac and of course the developed markets as well. So we don't read too much into the past. What we're interested in this is actually what's going on in the future. And with that, I have basically prepared some slides where we can actually go in and dwell into some of the key matters that are relevant to our portfolios. Next slide, please. So here we actually have the market expectations for US policy rates. We'll start with US first, broadly speaking, in terms of our macro strategies and macro views. Here you have a dot plot, which is represented by the blue dotted lines, and then what the markets, as implied by the Fed Fund futures, expect. As you can see, there's a huge gap between the dot plots of the members of the FOMC versus what the markets expect. So September was usually an eventful month. The Fed delivering a 50 basis point rate cut, actually lowering rates from a more than 2-decade high. On the other hand, the ECB implemented its second rate cut already of the year. Back to the US, the Fed remains confident that inflation is trending towards its 2% target. However, it still remains cautious, I think due to rising unemployment, a bit of weakness there, maintaining a view that the economy is fundamentally strong. So the core PC inflation, which is the benchmark, one of the points where US Fed Reserve is watching as part of their key policy rate movement, is now expected to reach about 2.2% in 2025. This certainly is at a faster rate than previously projected by the US Fed. Now, according to the dot plot, US Fed expects another 150 basis point cuts to reach the Fed fund rate of about 3.375 thereabout by end 2025. And if you look at the dot plot as well for the month of recent for November, December, you see the gap start to move wider. That means essentially we are going to see more rate cuts probably in the year ahead. And any rate cut certainly allows central banks in Asia an opportunity or a leeway to reduce rates without having to worry about their currencies in the foreseeable future. Malaysia, we expect Malaysia rates to stay about 3% for now. We'll talk a bit about other countries as we progress in our presentation today. So can I have the next slide, please? So in terms of what we see here, this is essentially the quarterly real GDP growth of US. US growth seems to be softening, but I think it's still resilient because the resilient middle and high income households and robust large business confidence seem to be helping to offset weaknesses stemming from lower income households and small businesses. Overall, we think strong household and corporate balance sheets should help prevent an economic slowdown or from turning it into a hard landing. The resilience of the US economy is expected to be, supportive of the broadening out of risk appetite and earnings expansion across companies and sectors. We think combined with rate cuts later this year, probably one in December, this creates a constructive backdrop for risk assets actually. And relative to other developed markets, we think US economic dominance will remain intact and continue versus markets like Japan and Europe, which are trying to get their act together as well, especially Europe. So we don't think there's going to be any hard landing. US essentially primarily is still very strong economically. So I think we don't foresee any recession taking place next year. Sorry. Can I have the next slide, please? So here we essentially have the real interest rates since 2010. This is essentially in Asia. When I say just now with US rate cut, Asia now has central banks in Asia now actually have room to cut. If you look at this chart, Malaysia, Korea, Thailand, India, historically, compared to say since 2010, the real interest rate has been very high. So here is an opportunity for these economies to actually cut rates, be it to spur growth or in any other areas that they see fit. Now there's a room because the gap with US now presents an opportune time to make some monetary move that can benefit their economies. Next slide, please. So with the current situation, we still don't see, because it's too early, we still don't see significant fund flows into emerging markets. If you can see this chart, essentially it is plotting the fund flows into emerging market bonds as well as emerging market equities. The blue light bars are emerging market bonds, and the pink part of the bars are actually emerging market equities. So as you can see, as at September, we still don't see significant moves. We hope this will change sooner than later. As Asia, we can interpret from this chart, is still very much under-owned. But we expect some significant inflows into Asia as we see earnings revision has turned generally positive for Asia. And most of all, the rate cut cycle in the US has actually started. So therefore, we think this is a very good representation of how people see their moving funds into this part of the world. And rate cut certainly in US and the resulting weakening of the US dollar probably presents itself an opportunity for people to do so in a meaningful way for us going forward. Next slide, please. So if you look at this one, it is actually a summary of what we think should be the key takeaway. We think in the sense of what I mentioned just now, in terms of macro views, the US has certainly entered into the rate cut cycle with the first 50 basis point cut in September. Inflation is moderating. And also in August, it was actually 2.5%. And then there's a recent weak labor market, but it may fuel expectations of slower growth. But the US consumer, I think, segment is still resilient. And so the base case for US is a soft landing. And also for China, we think the PBOC cut interest rates and the easing of reserve ratio requirement by 50 basis point is provided liquidity to support the equity market. And then the off-cycle surprise Politburo meeting and the statements made mention about stopping the decline of the property market. And this time we feel that the intent seems to be more serious than previous sessions. I think they have also pledged to conduct a significant rate cut. But although short on specifics, we do feel that the markets seem to take it more seriously this time. And I think for the first time, in my view, the president of China has made it clear and with more intent in his statement that admitted that China's economy is actually in problematic territory. So therefore, it spurs actually a huge inflow into the stock markets. And we saw how Hong Kong markets actually rose significantly due to some of the stocks that are related to China. And then when China actually reopened after the holiday, we saw how it continued to rally significantly. So we don't see any confirmation yet of any fiscal stimulus, although we saw a lot of monetary stimulus. So we think fiscal stimulus is what's needed. Some reports have put it at 2 to 3 trillion renminbi. Although Chinese government or any official has not actually announced the exact number or whether or not fiscal stimulus is forthcoming. But there was a report by Reuters, I think, which says 2 trillion. I'm not sure where they plucked the number from because nobody has confirmed nor denied from the Chinese side as far as this amount is concerned. But in our view, 2 trillion renminbi fiscal stimulus represents about 1.5% of GDP of China. It's not enough actually if you look at it in the overall scheme of things. So 2 trillion is probably something that's minimally acceptable going forward. And we view a number of maybe 8-7 trillion renminbi over the next 2-3 years will probably have significant impact if China is really serious about getting out of deflation. So we think the support for consumption is most important for now because business confidence, consumption confidence has been dropping significantly. So we think this is where we think China is. So for the rest of Asia, with China seemingly not being a drag anymore given the policy shift we see recently, we think the rest of Asia should bode well in terms of how China is panning out. But of course, this is not like 2-3 decades ago where the rest of Asia is pretty non-significant. But today we see Asia, the rest of Asia, i.e. ex-China, have become really significant, as we will see in some charts later on in terms of FDIs and how they have panned out over the last 3 to 5 years. So we see protectionist policies and supply chain diversification to be are expected to continue, especially for ASEAN, regardless of election results in US. We think the diversification, or some people say the China plus one policy, would benefit some, of course, some countries in ASEAN, especially Vietnam. So ASEAN is actually also under own. It certainly can benefit from foreign direct investment flows, tourism, as well as decent export markets going forward. So this is basically the background of the key takeaways of what will set the pace and the mood of the slides to come when I dwell a bit further into some of the details of the rest of the presentation tonight. So next slide, please. So this is a very busy chart. It actually shows the factors that we look at in one page. Essentially, it has some leading indicators there, chiefly among which would be the PMI indices for manufacturing as well as for services. We have inflation, economic activity, international trade, real estate, credit, financial markets, and interest rates. So again, we color code this because there are so many things to see here. Sometimes at a glance, colors will help. So if we look at this, red essentially means bad, green is good, orange and yellow means things are difficult. So if you look at this chart, China is an economy that's been in need of some serious significant stimulus for a long time now. If you look at the August numbers, the August column, September column is not fully populated yet because some numbers are not available yet. You will see that a lot are red in August. Even the green ones, for example, like inflation, it's nothing to shout about. In fact, the green you see in August is actually not a really good green because you see inflation numbers that are, a negative territory. This suggests, or this is a testament to China's deflationary pressures that they have had to deal with for a long time. So this is a snapshot. Hence, if you look at this overall scheme of things here, the numbers are not good. What can actually spur China going forward? So the answer is certainly definitely about policy shift. Definitely is about policy-driven improvement that the Chinese government need to, especially what I mentioned just now, fiscal stimulus to the tune of trillions of renminbi that is actually needed. Next slide, please. So here we have a chart explaining the policy shift that we saw, especially the couple of weeks ago, or 1 or 2 weeks ago, in the areas of housing, monetary easing, fiscal spending, and also certain PBOC easing package, especially new housing policies, monetary easing, as well as capital markets policies that will help to stabilize the stock markets. So China's recent policies, as announced a couple of weeks ago, is to stimulate growth. It is essentially putting in place what I have mentioned before, which is whatever it takes to improve China. So this is probably the moment, the whatever it takes moment for China to really realize and show to the world that they really can implement things that will help China get out of deflation. So Chinese equities actually rallied from depressed valuations, very light positioning, and coupled with expectations of additional fiscal policy. Amidst all this, China equities actually rallied, right? But despite this positive run, like I mentioned, fiscal stimulus and aggressive program to stabilize the property markets are still badly needed. So that China, can really get out of deflation in a meaningful way. And this surprise move, the Chinese policymakers announced a series of monetary easing measures and the establishment of a facility to support the equity market. There's a liquidity injection facility of about 800 billion renminbi. for the domestic equity markets. This essentially is made up of about 500 special loan facility for corporates and individual, for share buybacks, as well as for margin to purchase A shares by using equity holdings as collaterals. And then the People's Bank of China also continued to announce a range of stimulus measures in September with multiple easing policies. Examples are cutting the medium-term lending rates facility by a certain basis point. I think it's about 30 basis points, and giving cash handouts to the poor. These measures should be viewed as positive, and they are positive for growth momentum. But a full rebound in real estate is yet to be seen from what we can see. In any case, this is a testament to the fact that China is actually doing something constructive to address the issue of deflation. But broadly for Asia, we hope this will spur some investors, especially those outside of Asia, to really ask a bit more constructive questions about China, about Asia. We know that the allocation into China has been waning. This is probably a time where serious investors outside of Asia should start to question the sustainability of what China is trying to do here, and hopefully with that potential or potentially more inflows will come into Asia, and China benefiting most of the investors here, who I would assume already have had some allocation into China. Next slide, please. So this is a chart. It is a visual depiction of the shift that we saw a couple of weeks ago. And we see a big shift in tone in Chinese government in the implementation. But the real implementation, long-term implementation, meaningful, sizable implementation remains key. And long-term sustainability of any improvement in equity markets is dependent on macro recovery, and most of all corporate earnings as well, right? So the government needs to continue to roll out measures on both the fiscal and monetary front to improve household confidence. Markets are expecting, like I mentioned, 2 to 3 trillion, to meaningfully address this situation. Like I said, no announcement has been made regarding further significant stimulus. And what we saw are basically the front part of the blue curve in there. So the curve is not in any measure or in any scale. The blue curve is just a psychological way for us to show potential impacts of stimulus and fiscal stimulus on stock markets, for example. If you look at what they have announced so far, there's very little impact. What we need is the ones in the blue box, where funding from central government to focus on consumption, fiscal stimulus, social welfare, housing, local government debt, and as based on this, as economy stabilizes, housing sales turn less negative, we will probably see deflationary pressures subside, and this is where confidence will build up, and this is a step that is probably missing now. And if these steps can be implemented, we think the whatever it takes moment in China, we really see its true colors, and that's where we see going forward, China can improve so much better than what we are seeing now. By the way, the 2 to 3 trillion I mentioned was mentioned by Reuters. I'm not sure if the Chinese government was using Reuters as a way to just give some baits, just to bait the market and see what the response would be. But definitely it got people talking about the 2 to 3 trillion that we are seeing people talking around now, right? So we don't know when this will be announced. Certainly yesterday there was a meeting, but it probably wasn't the right organization that should be making the announcement. So as and when we see the next cycle of announcement, we will probably be expecting 2 to 3 trillion as a first announcement. It may not be, the next cycle. It can be any time, as and when the Chinese government sees it fit to announce a huge fiscal stimulus going forward. Next slide, please. So Now we are into the territory where we look at some of the themes and some of the strategies and some of the thought capital we have in how we can construct or maintain or improve our portfolios going forward. The central to all this is healthy earnings growth is expected in Asia in 2025. And that's basically the backbone as a fundamental, mainly a fundamental investor. We think earnings certainly will drive stock prices. So if you look at the growth in Asian economies first, in this chart, you will see an overall stable growth going to 2025. Some have slight improvement. So we see a US soft landing, playing out. We see monetary policy less restrictive. We see a healthy labor market. We also see services to continue to dominate US economy, and it's actually doing pretty well. The services sector in the US. So we don't see any major events in the GDP front going forward, based on what we see today. Next slide, please. So this is a chart of the earnings growth. Like I mentioned, we think earnings growth is a significant way of looking at how growth can impact stock prices. If you look at this chart, the first column is the list of the major markets that we are showing the earnings growth as well as the PE average per the representative index that we have for each of the markets here. If you look at the third column from the left, where it says earnings per share growth percentage 2025, you can see pockets of markets that have very strong double-digit earnings per share growth in 2025. China is about 11%, and you can see India about 15%, Korea in the high 20s. So will Taiwan and Thailand experience a high teens sort of earnings growth? Even Malaysia, we are near 10% based on this consensus forecast here. So we look at Asia, ex-Japan, about 13 to 15, So this is an area where we see Korea and Taiwan seeing a very strong, higher EPS revision versus the other major markets. And this is a chart where you can actually use to see where the attribution of growth can come from in a portfolio going forward. It is a pretty decent, accurate way of looking at how growth can be derived going forward in each of the markets. Having said that, this is a macro view. In any portfolio that we construct, the bottom-up factors are still very part of how we construct the portfolio. It is not only based on top-down macro factors. We also look at company matters as well. So essentially, when you buy equities, you're essentially buying into companies' growth, right? You're not only just buying a piece of certificate or like account in your stock market account where you have a certain number of shares in the company. You're actually investing in the growth of the companies, and growth sometimes come at expensive prices, right? It comes at a price, right? So it depends on where your priorities are. We think investing into growth alone would be missing something. We think investing into growth plus some yield would make it complete. That's where the portfolio in question that we'll be talking about today at the end is investing into growth as well as a decent amount of dividend payout in some of these companies. So when you buy Asian equities, you're buying into the growth of Asian companies, right? And we also do include companies that are not listed in Asia, but that have significant revenue or cash generation from this part of the world. So this is how we look at growth. And from this chart, we can see the attribution, we can see the geographic allocation. Hence, we always believe any allocation in any Asia portfolio should be as diversified as possible in terms of sector and in terms of country allocations as well. Next slide, please. So this is how we see the 2025 earnings in a little bit more detail. We are constructive on Asian equities. Our in-house earnings growth forecast for 25 is about 14-15%. It's about 15 actually, slightly more than the consensus estimates of about 14%. The additional confidence we have versus the market consensus essentially comes from China. So we are more confident than the street as far as China is concerned, as far as Thailand is concerned, Singapore and Taiwan. In these markets, we like beneficiaries of AI spending, corporate value up programs, improving consumption, capex, and as well as the beneficiaries of low interest rates. As I mentioned earlier, Asia central banks now have options to lower interest rates. So if you look at this US rate cutting cycle now and the positive earnings revision, we are positioning our Asian portfolios to benefit from strong earnings growth. Top of mind, of course, the things I mentioned just now: AI spend, rising capex, as well as consumption. We think China, especially in domestic-oriented companies, will be a focus. Companies that have shown signs of turnaround, improving top line and margins. And take note, China is significant here because China is about a quarter of our Asian portfolios. I'll show you our Asian portfolio later on as to where China stands in terms of asset allocation. And important to us are also companies that are able to deploy capital efficiently, manage costs, and also can declare high dividend yields. That's part of the portfolio that we're talking about here, right? It's growth and it's about dividend yields. So we are positive, more positive than the street for Singapore. We think Singapore probably we are slightly ahead of consensus as well in 2025 because we are bullish on telecommunication earnings in Singapore. We also like REITs, but albeit REITs is a yield play in Singapore. It's no longer very much a growth play. Some say because Singapore's leasehold lands and properties are probably towards the tail end. So there's not much growth to be derived from such situation. But growth, but yield, right? Earnings yield is improving, and that in that sense, REITs are finally seeing a decrease in interest costs as well with interest rate cuts on the cuts as well. There are also some ongoing themes on GLC reforms, through operational improvement, shareholder return, and that's trying to drive share prices further. So that's why we are more bullish on Singapore than the markets, right? So we think Thailand as well is we're more bullish than the street. Thailand, we think there's going to be good consensus EPS growth in 2025. We prefer ICT, internet communication technology, some consumption, some healthcare sectors like healthcare in Thailand has been pretty strong over the last few years, and also medical tourism has been strong as well, with state-of-the-art and global scale, global class hospital and facilities in Thailand. So we see some of these sectors have limited risks of EPS downward revision. We try to avoid in Thailand. We try to avoid energy and materials because we see some downside from core and non-core operations. So with that, we think if you look at the chart, the principal one is the dark blue, and the green, the lighter blue is the market consensus. So in some markets, like I said, China, Singapore, and also Taiwan, Thailand, we are a bit more positive. Next slide. So other areas that we like for Asia in general, Asia-Pac in general, is semicon. This is a chart of semicon or global semiconductor sales. The blue bars with the label on the left is global semi sales in US dollar billions, and then the red line is the growth rate year on year, a label on the right hand side. So if you look at the current tech cycle, it is heavily skewed towards cloud AI. But overall, semicon is an area we like. Of course, the most significant component within semicon are those related to cloud AI. This segment is actually growing really, really fast, but the consumers of semicon like smartphones and computers, autos, EVs, industrials are doing great, but they can be much better. We think improvement will come probably next year. But for now, by far, AI is doing much better. So we think the rest of the segments outside of AI will follow suit and will probably improve starting next year. Now, questions relating to tech sector is always about, they spend so much, in capex, the question is how fast and how meaningful the ROIs or the rate of the return on investment will be or can be realized rather. We have to understand that the largest hyperscalers in this world, right? They have always maintained that AI tech investments relating to application development and deployment have very, very long dated ROI period, right? So in essence, if you look at AI, for example, is no longer at the developmental stage that we saw last 2-3 decades. No, the AI we see today is already in the application state. The application stage as well is where you and I consumers have benefit of using them now. For example, your Copilot, and these are actually playing well into some of these big tech companies. It's like Microsoft Copilot, where they can really monetize it to a great extent, and this sort of monetization, because of the deployment and consumption and application, is a very long dated ROI if you were to look into it from scales point of view. So the great thing about these companies is that they have deep pockets, they have great financial resources to maintain those investments over the long term. So I think there's no denying AI is something that's here to stay. It may be in a different style or different a different format, different form and shape going forward. But we see how AI has started this new trend, and we think it's definitely here to stay. Next slide, please. So this is a very important chart, and I think earlier in my presentation, in my introduction, I mentioned a lot about FDI, especially Asia Greenfield FDI. This chart is significant because it tells a story about how Asia has greatly diversified away from China in a significant way. If you look at this chart, it consists of 5 bar charts, and each bar chart has different component with different colors. Each color denotes a different country, and then the significant one, if you see, are the blue components in all the 5 bars. The blue part bars at the bottom, especially, you can see these are China's FDI, and indeed, if you see from 2019 to 2023, FDIs into China has deteriorated. The blue part of each of the bar has not been growing. In fact, 2023 one is lower than 2019, and in between you see how China did badly. 2022, there was a time of COVID, and China's reopening, the late reopening, actually had negative impact on the country. That's for sure. But if you look at the overall trend, don't just look at the China's blue component. If you look at the overall trend, the height of the bars since 2019, it dipped 2020, dipped in 2021, but since 2022, you can see how it has gone up tremendously, surpassing that of 2029. So it has surpassed pre-COVID. FDI is remained really strong. What's interesting here is, FDIs into Asia is more diversified now. I want to highlight, the contributors have been stronger from countries other than China. You see India, you see Vietnam, you see Indonesia, even Malaysia in the purple part of the bar has seen significant improvement versus 2019, right? And FDI is significant for the fact that FDIs take many years to materialize. An FDI, will take many years to churn out their end objectives. That being said, it is a good trend. FDI is a good trend for us to have a good forward-looking indicator of potential growth in any market or any region, in this case, Asia. With supply chain diversification taking place, China plus one, Vietnam being beneficiary of that, not to mention Indonesia and Malaysia as well. This indicator here is certainly positive for Asia and ASEAN in particular, as far as FDI is concerned, playing into the economies of where we are investing in, right? So with FDIs, of course, there's job creation, there's infrastructure development, there is financial that's needed, So overall, the key sectors of economy certainly will benefit. So this is where this chart, it may look simple, colorful, but it is a very important message here to mention. Next slide. So this is tourism, and this is very specific to ASEAN. As you know, ASEAN has been a magnet, tourism magnet, and Thailand has been one of the most popular countries, not only in ASEAN, I think in Asia and around the world when it comes to tourism. But if you look at this chart, amongst Thailand, Malaysia, Singapore, Indonesia, Philippines, and Vietnam, the red bar is the previous years pre-COVID, and then the red one is forecast for this year as at August 31st. And if you look at Thailand, this year forecast to receive 35 million passengers, inbound visitors. It is not at pre-COVID level yet. Having said that, 35 million inbound passengers in a year is significant, right? It is even more than Malaysia's forecast of 27.3 million, whereas Malaysia's 27.3 million will exceed its pre-COVID levels already, right? So Thailand is significant, although they are facing certain issues. And recently we've seen how Thailand has been grappling with strong currency versus US dollar, which they think is a drag on tourism. And Thailand government and the Central Bank of Thailand is certainly doing something about it to ensure a stable currency or the baht going forward. Singapore as well, still below, but significant. Indonesia will probably be way above or above the pre-COVID level. Vietnam and Philippines stable. So this is a very important indicator of potential growth, because tourism, it's certainly, it tells how a country might do in terms of very important FX receipts, right? Foreign currency receipts. And this is playing well into countries like ASEAN, where foreign reserves is certainly important. Next slide, please. So everybody has been talking about India, and we all know India as well. For those of you who have been following the India stock markets, valuation is probably about 25, 26 times going forward. And I think it's probably the most expensive from a PE point of view of all major markets in the world, including S&P 500. So the question is, does India have legs? Will it continue to grow? Horror stories on the ground about how small cap stocks or small cap companies, despite having very low revenue, have not been able to really garner a lot of sales, but when it's listed, it's doing extremely well. Okay, so I think India markets are resilient. It has a large consumption base. Government support of manufacturing and infrastructure is great. They're trying to attract FDIs as well. But by fundamental, the third point, which is India's capex renewal, is very important and has had positive impact. We think India will continue to attract FDIs and also, most importantly, capex, right? The blue bars are the capex expenditure of India. And you see before 23, the capex in India has largely been flat, as shown in the bar charts from 2015 to 2022. Well, of course, 2021, 2022 was COVID years. We see significant improvements from 23 onwards to 24. So this, of course, having come from low base, but we think 23 and especially 24 is certainly not a case of coming from low base, because 23 is higher than the rest of the 7 8 years before that. So we think the surge has been India's resolve to domesticate the industries and to transform itself to a renewable energy, to a manufacturing powerhouse, and also to be more active in the renewable energy space, right? So we think India doesn't want to have to rely on importing components of alternative energy like solar panels anymore from China. They want to be self-sufficient, and this is where the capex came in. So having said that, India, if you think India is expensive, not only that, it does have other challenges. But India, if you are playing it well in terms of stock selection, it is a market that has plenty of opportunities. So India may have its challenges. For example, dependence on oil imports, full dependence on oil imports, right? Or electricity demand, which is higher than electricity supply. So power demand is certainly higher than power supply. So, but turning again in selective mode in how you invest in India, turning negative into positive means there are opportunities as well, especially in infrastructure companies, which build the power grids, power plants, cement companies, and financials as well that finance such constructions. So we are constructive as well, to a certain extent in India, in certain sectors that we think will do well going forward. I need to speed up a little bit here. So India not only has capex. If you look at the chart on the right hand side, this capex, the capacity of this capex is actually being utilized. As you can see from 2022 onwards, you can see how the utilization of its capacity has actually really increased, right? So it's not just about building, it's about actually utilizing them for meaningful economic activities. Next slide, please. So in conclusion, in terms of how we see Asia panning out, volatility may remain elevated. It's no brainer. As we head into US election season, volatility is to be expected, especially for Asian markets, with issues like US trade relations with China. These will be very hot topics, right? But we think fundamentals and earnings growth will be the primary drivers going forward. And for those who have very little in China in the portfolios, the past 2 weeks have been, I think, very painful for you. I think most Malaysians have allocation in China, probably less so since 2-3 years ago. But we see the recent resurgence as a lesson for us to be very diversified in our portfolio, because we always see things will turn around whenever there is good news or certain policy shift, like in the case of China. So I will go straight to the portfolio. If you can turn to the first page of the portfolio, so we can talk about the portfolio. So let's go. Yeah, okay. Let's talk about the portfolio that we're talking about. The representative portfolio we have here would be the Asia Pacific Dynamic Income Fund. And we have here the top 10 holdings, so that you get a feel of what we're talking about when we say the things we say just now. So we have about equities, 25% cash, 95% invested, sorry, about 4.3% cash as at 31st August. Still very much the same now. That tells you the confidence we have in the market. And the top 5 holdings account for 27.5% of the portfolio. The top 20 holdings account for 63% of the portfolios. So that means this is a highly concentrated portfolio, a high conviction portfolio. But the strategy spells out that it is unconstrained. We are not bound by any allocation that we have to follow in any market benchmark or any index. It is high conviction portfolio. Is well diversified across sectors, well diversified across countries, and it invests mostly in big caps. The size is about $1 billion now, US dollar. And we have had this fund since 2018, 2011, if I can recall. So it has more than 12 years of history, and it targets 8% per annum in the medium to long-term cycle or rolling period. So if you look at the portfolio here, when we construct a portfolio, the macro factors like GDP growth, industrial indicators, the things that I talked about just now are not the sole determinant. They're just part of it, right? There are other things like bottom-up non-macro factors like companies' profitability, market share, product quality, tech adoption, capex, dividend history, etc. They do play significant roles. An example of some of the ideas we like, idiosyncratic ideas. Idiosyncratic ideas, for example, if you can see in the portfolio, the 9th largest holding, which is E Ink Holding Incorporated, a Taiwan domicile company. So E Ink has a market share in the e-paper segment. It is the world's largest patent holder. So e-paper segment manufactures display panels. Examples are display panels you see on your Amazon Kindle ebook. Display panels you see used by advertising companies, especially in the digital out-of-home or DOOH advertising. Which is getting popularity these days. We also have BMW cars that you saw at one time. They advertised how in future BMW cars can change color on the spot with the flick of a button. So this panel are actually manufactured by E Ink, right? It is not a new company. It's been around since the mid-90s. So it's gone a long ways, right? So for example, DOOH, digital out-of-home advertising, it involves advertisement boards that can be controlled digitally outside of in the remote control way, right? That means it can be a headquarter and it can control advertising boards all over KL or in Asia, or I mean in Malaysia for that matter. So these are obviously more superior than the traditional sticker posters, right? Or giant fixed billboards, right? So a key advantage of DOOH signage is ability to be more targeted. Example signages, when you go home at the MRT stations, you see, restaurants advertising their dinner menus, right? Because that's the time when people go home and trying to find dinner at the time. Or during lunchtime, lunch crowd, people go out to MRT to find lunch, and suddenly they just with a flick of a button, they can change the content of the boards, right? Digital boards, for example, showing lunch or restaurants that are around the area. So it's very targeted, it's fast, and so demand for such panels are certainly on the rise. And we see this company, E Ink, benefiting from such a venture. Of course, other holdings here you will see will probably be surprised by Hitachi and Japan. There are two holdings in Japan there. I think Taiwan Semiconductor is not a surprise. So Japan, Hitachi, for example, is not just your TV or your aircon or your hi-fi or your white items or your white things that you use in the kitchen. They are certainly more than that. There is even more than the equipment that they sell. Construction equipment, they are actually into IT as well. It is a pretty big player in Japan. It's the IT services company as well. And Hitachi certainly is, I think it's number 2 or number 3 in Japan. It is there in Japan when Japan is underinvested in IT. So the potential is certainly huge, right? Not only in IT services, Hitachi is also involved in power grid improvement and construction. As you know, power grid is an important part of renewable space. Not only do conversions needed in terms of for it to be able to cater to solar energy, for example, there is also an increased capacity. There is also an increase in capacity as AI segment, hence data centers are built. As you know, AI and data centers are power hungry, right? So there is a need for such more infrastructure, and there's also a demand for upgrades to cater for high voltage current or direct current or HDVC development, as you see in Europe now. And China is also huge in HDVC construction, but of course China is not a market for Hitachi. Hitachi derives most of its revenues in this space from Europe actually. TSMC, of course, is there. It's no-brainer for any portfolio in Asia not to have TSMC. It is not just a contract manufacturer. It is actually a very large, a very efficient, and huge in tech gap advantage over its competitors like Intel, right? And this essentially is the portfolio. And as you can see, we have others here: Samsung, Tencent, CNOOC, and NTPC. If you were to go one slide, oh, sorry, the next slide. Just want to end with this next slide before we go to a Q&A, if you're patient enough to wait. So I just want to show you the country allocation, just to show that we are very well diversified, not only in terms of country allocation, but in terms of the the sector allocation as well. As you can see, this is as at 31st August. If you can see there, Hong Kong on top, 18.3%. And if you go down there towards the last, or the second last or the third last, there's China 1.1%. So China 1.1% is actually the A shares, the mainland China shares. And then the Hong Kong SAR China is 18.3. So the Hong Kong actually is majority made up of China-related companies, the CNOOC of this world, the Tencent of this world, the Alibaba of this world, right? So combined, we safely say Hong Kong and China combined is attributable to China with about 18%, roughly 17-18%. But this was 31st August. Lately, we've bumped this up to, I think, about 25-26%. Probably will remain there, depending on how China turns out going forward. We may relook at the allocation in China and make the necessary adjustments. Because today, China is very much a policy-driven market. It's not so much a private sector-driven market yet. So unless China flips or to a more private sector-driven market, we shall continue to be cautious and watch the market carefully and see signs of any stimulus package or fiscal stimulus package, to be more specific, that I was mentioning about. So hopefully, we will be able to raise our allocation to China going forward, because we see it as a significant market in Asia. So I think that's basically my presentation. If you want to, we can move on to the Q&A for the remaining time that we have. Elise.
Okay, thank you, Mr. Harry, for insightful presentation. Now we proceed to the Q&A section. The first question is, with the recent China stimulus announcement, should investor focus more to China than Asia Pac market?
That's a very obvious, very good question in everybody's mind. From the chart that I showed you just now regarding FDI, it is obvious that China, I don't want to say it's less significant. It is very significant still, but there's been a diversification away from China, because China is never viewed as a place like with low wage labor cost anymore. China is expensive in terms of labor costs, relatively speaking. China is already an aging society, an aging country as well. So there are other countries that have taken over in what China was previously doing. Of course, India is one, Vietnam is one, ASEAN is another one. So I think as significant as China is in any portfolio, yes, you should be diversified. But this recent announcement, the policy shift by China has made it more significant for us to relook at our portfolio and say, is China something that we want to be, having more in our portfolio these days? So I don't have a direct answer, yes or no. We have to look at your overall portfolio, your overall risk profile, your age, and how you see this going forward. That's basically my answer to that.
Okay, we proceed to the second question is, what is the impact of the USA election? Will trade war 2.0 happen?
I'm not sure if you call it trade war 2.0. When was trade war 1.0? As far as I can remember at my age, trade war or trade issues with China, between US and China, have been going on since Nixon's days, since Gerald Ford's days, since Barack Obama, George Bush Sr., all the way now to Biden, and before this Trump, and going forward could be Trump again, we don't know, right? So it has always been an issue. So hence we don't think it is something that you look forward to anymore as a game changer. Yes, it is still significant in how it shapes our view of the volatility that's to be expected. But we don't think we can formulate such things of political nature in our investment equation anymore with high accuracy. You also have your geopolitical issues in Europe as well, Middle East now. We don't know how it's going to play out, right? So we stick with the fundamentals. We stick with what we can see, what we can control, and what we can get out and not get out of. And hence we think it will always be a thorn in the flesh when it comes to US-China relations. But hopefully with the China plus one, it takes away the heat a little bit, and fund managers will have more room to maneuver when it comes to this segment of the economy that they want to invest in.
Okay. Another question is USA Federal Reserve is starting the rate cut cycle. Should I focus on USA technology sector rather than Asia Pacific market?
So we cannot deny US big tech companies will do well, and more so, in fact, with US rate cut cycle coming into play, not only big tech will do well. We have channel ground studies that show that in US, the smaller tech companies, the startups, have started to spend more in capex for the IT development. So I think not only big tech, overall the smaller tech, the medium tech, the startups. And in the overall scheme of things, the US small cap in growth sector, whenever there's a rate cut, will certainly and probably do well or do better. So again, you cannot neglect Asia as well. We've seen in the past 30, 40 years, whenever there's a rate cut in US, Asia markets, including China, tend to do better. It is a technical fact that we've seen decade after decade. So this is the time. When there's a rate cut in US, Asia will do well. So the best policy, again, like I said, diversify, because we don't know what's next, what's in store for us tomorrow. I think diversification is the way to beat this.
Okay, thank you, Mr. Harry. Due to the time constraint, I think we will take the last question is, if the Middle East conflict escalating further, should I focus on global instead of equity?
I don't know. The oil price hasn't moved much, even as war rages in Israel, Gaza, and now in Lebanon as well. And there's no let up by Russia when it comes to Ukraine. And we have a change in government thrown into the fray where we don't know what's going to happen. So again, we cannot formulate or put in formula these events, but we do know war is not the first time. We've had Middle East war many years already, and I think people are probably gotten used to it. We certainly want to avoid nuclear kind of war, but other than that, as we see it, diplomacy will win, or the war will prolong and nobody cares anymore. But in any case, we focus on areas where we can benefit, and there's plenty, right, outside of areas that are not impacted by such events. So I think that question is a very difficult question. It depends on your risk profile as well. It depends on your preference. It depends on where you are in your life cycle. Can you take more risks? If yes, yeah, by all means, right?
Okay, thank you so much, Mr. Harry. Ladies and gentlemen, this will be the end of our Q&A session. And then if let's say you have any further question, you may drop us an email to our investhelp.my@fundsupermart.com. And lastly, I will share about tonight, after attend this webinar, right? Actually, we got one campaign. For attendee who attend this webinar, right, unlocking opportunity capitalize on Asia Pacific dynamic equity market, you will receive a 0.8% promotion code. The code we will send after this webinar, and then use it to investing in selected principal asset management unit trust. Included the invest 1,000 in Asia unit trust, get 10 ringgit bonus unit campaign from today until 14th of October 2024. And then the first 30 webinar attendee, right, who utilize the campaign code to invest minimum of 1,000 in a single transaction, in one or more selected principal asset management Berhad unit trust, you will receive 30 ringgit touch and go e-wallet reloaded pin. So for more detail, right, you may proceed to our website. And then for today, this webinar, you may proceed our social media, YouTube or Facebook to replay the live, just this one, the live. And then once again, thank you, Mr. Harry and everyone who attend this webinar. Good night, everyone.
Thank you. Thanks, everybody.